You are in the hidden stage. You know the patterns. You understand the indicators. You could draw the support and resistance lines perfectly on a whiteboard. You have the 90% of knowledge required to be consistently profitable, yet the 10% gap in execution feels like an uncrossable chasm. You feel like a highly trained pilot who constantly crashes the plane just before landing. Why? Because you are still treating the market like a personal competition. You are trying to outsmart the market, not simply participate in it. This is the stage where most traders quit, not because they lack intelligence, but because they lack the proper psychological framework to handle the inevitable volatility of capital. Every time you click the mouse, you are not just risking capital, you are risking your self-perception. That green number on your profit and loss statement is currently functioning as a reflection of your worth, your intelligence, your discipline. And that red number, it is a direct assault on your ego. This is why you hold losers too long. This is why you refuse to admit you were wrong. The loss isn't just money. It is a confession of error. You are attached to the outcome because you have fused your identity with your trading performance. You are judging the quality of the surgeon by the outcome of a single operation, ignoring the fact that the surgery itself was executed perfectly according to plan. This is the anchor that is dragging you under. You must break the fusion. This dilemma, the internal war between ego and objective reality, is not new. The necessity of separating self-worth from external outcomes is perhaps the oldest battle in high-stakes endeavors. Rather than charting this psychological territory alone, the serious professional can utilize the definitive treatise on internal fortitude, the Meditations of Marcus Aurelius. This essential volume, particularly in the meticulous 2025 translation by Rowan Ashworth, offers the precise framework required to neutralize the emotional noise that sabotages execution. It is the blueprint for building the detached mind required for sustained profitability. For those ready to begin the work of internal mastery, a link to this specific edition is provided in the description below. The promise of detachment sounds simple, doesn't it? Just stop caring. Just be emotionless. But that is where the confusion begins. You think detachment is the absence of feeling. You think it means apathy. You try to force yourself into a state of emotional numbness, and all you achieve is burnout and sloppy analysis. True market detachment is not apathy. It is the opposite. Apathy leads to laziness. True detachment requires a level of focused, surgical precision that most traders never achieve. It means caring deeply about the process, while caring zero about the outcome of any single event. Think of the sniper. The sniper is detached from the target's life, but they are intensely attached to the perfect execution of their breath, their trigger pull, their wind calculation. If they become emotionally invested in the target, their hand trembles. If they become emotionally detached from the process, they miss the shot completely. You must treat your trading plan with that level of reverence. You need to stop asking, "Will this trade make me rich?" and start asking, "Did I execute my edge flawlessly?" The first question breeds anxiety. The second question breeds consistency. The market is a system of probabilities, and probabilities do not care about your feelings, your rent payment, or your belief system. When you approach the screen with this emotional baggage, you pollute the data. You think detachment means caring less. The truth is, it means caring about the right things and ignoring the rest. I will show you exactly what the right things are, and they are not what you think. They are not the profit and loss. They are not the indicators, and they are certainly not the size of your account. They are the invisible levers of your own mind that you have yet to master. The largest, heaviest invisible lever is your ego's desperate need to control the outcome. You spent hours drawing lines, confirming confluence, backtesting the data, and now you believe that meticulous preparation entitles you to a win. You believe your analysis is so superior that the market must bend to your will. This belief is the single most expensive mistake you will ever make. It is the fundamental flaw in the intermediate trader's mindset. You are not trading the chart, you are trading your expectation. And when the market inevitably rejects your expectation, the ego fights back. This fight has a name. I call it the ego tax. The ego tax is the capital you pay, not for being wrong. Because being wrong is free, it's just data, but for trying to prove you were right. Think about the last 5 times you took a loss that was far bigger than your initial risk. How did it happen? Did you move your stop loss down just a little bit, whispering to yourself, "It has to turn here. It's going to reverse"? That is the ego tax. Did you take a massive, oversized trade immediately after a small loss, purely motivated by the need to get your money back right now, often called revenge trading? That is the ego tax. Did you overanalyze a position after you entered it, changing your take-profit targets based on a sudden rush of fear or greed? That is the ego tax. The market does not charge you for volatility. It charges you for your personal instability. The brutal truth is that once you click the button, once you submit the order, your analysis is statistically irrelevant to the outcome of that specific trade. Your edge is defined over hundreds of trades, not one. The market does not care how smart your model is. It does not care about your mortgage payment. It only cares about the flow of capital and the distribution of statistical probability. Control is an illusion because the outcome of any single event is random, even if the system generating those events is weighted 60% in your favor over the long run. You must internalize and accept that your winners and losers are randomly distributed. You cannot force the next trade to be the winner, just as you cannot force the next card dealt from a shuffled deck to be an ace. Trying to micromanage that randomness is precisely what destroys your statistical edge. You are systematically dismantling the very advantage you spent months building. Your focus on the individual outcome is the definition of trading desperation. You are confusing prediction with probability. Prediction is an act of ego. Probability is an act of surrender. There is a place where all those micromanaged trades go to die. I call it the trade cemetery. It is filled with the ghosts of trades that were perfectly fine, statistically sound, until you laid your hands on them post-entry. Every time you move a stop loss, every time you prematurely take profit out of fear, you are digging a grave for that trade. You are suffocating its statistical potential. You are ensuring that the inevitable winners within your system never get the chance to express their full profit and loss potential. You are systematically clipping the wings of your winners while letting your losers run wild, all because your ego cannot handle the perceived humiliation of being wrong. You must internalize this truth. Your job as a systematic trader is to manage the process, not the result. The result is the market's job. Stop trying to steer the ocean. You are only steering your own account into the rocks. The market has infinite capital and zero emotional attachment. It is pure mechanism. If you meet that mechanism with personal grievance, with anger, or with the desperate need to be right, you will be crushed by the imbalance. You cannot control what happens next, but you can absolutely control what you do next. The ego tax is the highest tax you will ever pay in this profession, but how do you stop paying it? How do you surrender that need for control without becoming reckless? The answer lies in establishing a boundary so clear, so rigid, that the ego cannot cross it. It is the final, non-negotiable rule that separates the profitable from the perpetually frustrated. It is the concept of trade finality, and it is the key to true detachment. Trade finality is the destination. Hope and fear are the gravity wells pulling you off course, making that destination unreachable. You believe you are trading the chart. You believe you are executing a strategy. But if you are truly honest with yourself, you are not trading the setup. You are trading the feeling of being right. You are trading the confirmation of your own competence. We need to dismantle that feeling. Let us define the 2 anchors that destroy detachment. The first, and arguably the most destructive force in the intermediate stage, is hope. Hope is the emotion that targets your losing positions. It is what keeps you in a trade long past your established stop loss. It whispers, "Just a few more ticks. It has to bounce here. I will break even, then I will exit." Hope is the enemy of discipline because it promises a retroactive justification for violating your rules. You will tell yourself that you knew it would turn around. This is the core mechanism of the average losing trader. You are not losing because your strategy is flawed. You are losing because you are allowing hope to apply emotional leverage to your profit and loss. It is a slow, agonizing bleed. Now consider its counterpart. Fear. Fear is the great destroyer of your long-term statistical edge. Fear targets your winning positions. When a trade finally moves decisively in your favor, fear steps in. It screams, "Take the money," before it disappears. Don't let it turn around and take back what you earned. This is the fear of loss aversion, applied to paper profits. You exit too early, crippling your average winner size. You secure a small win, but in doing so, you sabotage the entire statistical expectation of your system. You trade for certainty, not for expectation. You trade for the immediate relief of closing the position, rather than the compounding growth of letting winners run to your established take-profit target. Why do these two anchors, hope and fear, have so much power over you? The answer is simple and terrifying. Emotional leverage. It is not financial leverage that ruins most traders. It is emotional leverage. When you size your position beyond your psychological comfort zone, when the potential dollar loss or gain is large enough to fundamentally change your mood or distract you from your life outside the screen, you have leveraged your emotions. This is the point where detachment becomes a physical impossibility. You are no longer watching a chart. You are watching a direct readout of your self-worth. Think about it. When the position size is too large, the pain of the loss is magnified, fueling hope to hold on longer. Simultaneously, the fleeting pleasure of the gain is magnified, fueling fear to snatch the profit prematurely. This pressure warps every decision. When hope and fear collide in your mind, they produce only one dangerous output: rationalization. This is the subjective equation of the struggling trader. You rationalize holding the loser by citing some irrelevant piece of news, and you rationalize cutting the winner by claiming, "A bird in the hand is worth two in the bush." Every decision becomes a defense mechanism for the ego, not an objective execution of the plan. You are protecting your identity as a smart person, not protecting your capital. We need to dismantle that internal defense system. We need to replace the trading of feeling with the discipline of indifference. Indifference is not carelessness. It is the ultimate form of respect for the market structure. It means the outcome of this single trade holds zero emotional significance for your identity or your overall financial health. It means your focus is entirely on the mechanical process. You are simply the operator, not the judge. The market does not reward hope. It does not reward cleverness. It rewards mechanical, surgical acceptance of reality. The moment you accept the loss, you free yourself. The moment you allow the winner to run, you validate your system. The question remains, how do you achieve this state of true indifference when the money on the line feels so real? How do you neutralize the emotional leverage you have unknowingly applied to yourself? It starts with the absolute acceptance of trade finality and the understanding that the boundary we must establish is not external. It is internal, and it is governed by the size of the risk you are willing to truly forget. That internal boundary, governed by the size of the risk you are willing to truly forget, is not a passive acceptance. It is the absolute highest form of active intentionality. True detachment is the calculated, pre-entry surrender of the capital you are placing into the market's mechanism. You must accept the loss as a sunk cost the very moment the entry button is pressed. If you cannot look at that money and genuinely believe it is already gone, you have not defined your risk properly, and you are trading with emotional leverage. This is where the illusion of detachment fools the intermediate trader. They confuse detachment with apathy, believing that if they just try to care less, the results will follow. That is not detachment. That is denial. And denial always leads to emotional blow-ups when the market inevitably tests your limits. True detachment is highly skilled. It requires you to care more about the how than the what. You are not trying to stop caring about money. You are trying to rewire your brain to care about the integrity of the execution above all else. Detachment is not laziness. It is the relentless pursuit of objective process. This brings us to the central, uncomfortable paradox of professional trading. The only way to achieve true indifference to the single trade's profit and loss is to become intensely, religiously attached to your process rules. You must become a fanatic for the rules of entry, the rules of stop-loss placement, the rules of scaling, and the rules of exit. You must be obsessed with the flawless execution of your proven edge. Why? Because if you follow the rules perfectly, the outcome, win or loss, becomes entirely irrelevant to your identity and your self-worth. The outcome is simply a data point within a larger statistical framework. The professional trader is intensely attached to the execution and completely detached from the result. The amateur is intensely attached to the result and completely detached from the execution. Think about that imbalance. The amateur focuses all their emotional energy on the one thing they cannot control, the price movement after the entry, and ignores the one thing they absolutely can control, the adherence to their established rules. This intentional separation is what we call the mechanical mindset. It is the programming of your central nervous system to see every trade setup not as a personal lottery ticket, but as a statistical distribution problem. When the setup criteria are met, the action is compulsory. There is no debate. There is no hope. There is only execution. When you start seeing trades as statistical data points, they stop being personal validation points. The market is no longer judging you. It is testing your system. This shift neutralizes the emotional leverage immediately. The mechanical mindset understands that the goal is not to win this specific trade, but to execute the system perfectly 1,000 times, knowing that the law of large numbers will take care of the profit factor. This is the required mindset reset. If you are still asking, will this trade work? You are asking the wrong question. The professional asks, did I follow my rules perfectly? When you achieve this state, the market can take your stop loss, and you feel nothing more than a slight technical correction. You feel no sense of personal failure or betrayal, because the loss was accepted the moment you entered. The potential loss was simply the cost of doing business, the ante required to play the hand. This level of true detachment requires building a specific mental infrastructure, a firewall. This firewall must sit between the chaotic, emotional input of the screen, the flashing red and green numbers, and the logical, decision-making center of your brain. It is the mechanism that allows you to take a 10% draw down without feeling a single spike of panic, because the firewall has already quarantined the emotional impact of the money. Achieving this requires a specific mental reset button, a firewall you must build between your screen and your central nervous system, which I will outline next. This architecture of surrender begins with what I call the pre-mortem ritual. You are trained to plan for profit. I need you to plan for the loss. Before your finger clicks the execution button, you must mentally or physically complete the pre-mortem. It is the act of planning the loss and planning the recovery, long before the outcome is known. You must write down 3 things. 1. The exact dollar amount of the loss that will be triggered by your stop-loss level. 2. The immediate action you will take when that loss hits. Not a trade, but a non-trading action, such as closing the platform or walking away for 30 minutes. 3. The precise emotional state you will allow yourself to feel for exactly 5 minutes, and then how you will consciously terminate that emotion and return to neutral. This ritual drains the anxiety because you have already metabolized the outcome. You have already paid the emotional insurance premium. The loss is no longer a surprise. It is a factored cost of doing business. Now for the trade itself. You must adopt the zero expectation rule. This single trade, in isolation, means nothing. It is a coin flip. It is a single data point in a vast ocean of probability. The market does not owe you anything on this specific entry. Your job isn't to make money on the next trade. Your job is to prove your system works over the next 50 trades. That shift is the architecture of surrender, and it is the only way to stop watching the candle. Stop watching the candle. If you are focused on the 50 trade sample, the immediate profit and loss becomes irrelevant noise. So, we must change what you measure. Stop tracking money daily. Start tracking compliance. Your new key performance indicators are not financial. They are behavioral. You need an execution score. Did you enter exactly at the planned level? Did you follow your sizing rule? You need an adherence rate. How many times did you move your stop loss? How many times did you prematurely adjust your take-profit target? You are no longer paid for winning trades. You are paid for perfect execution. The money is simply the delayed, inevitable result of perfect execution. If you meet your behavioral metrics, the money follows. If you chase the money, the behavior crumbles. This is where most intermediate traders fail. They confuse the outcome with the process. Once you have executed the trade and set your protective measures, the non-negotiable stop loss and the predetermined take-profit levels, your work is done. Physically, the trade no longer belongs to you. This is the moment for true physical separation. Stand up. Walk away from the screen. If you feel the intense emotional pull, the need to check the chart, that energy must be redirected. Do not dump that energy back into the market by adjusting your levels or adding to the position. Dump it into your trading journal. The journal is your emotional transfer station. Write down the feeling, the temptation, the exact thought that is trying to pull you back to the screen. By documenting the fear, you transfer the emotional weight from the open position to the written record. The trade is now running on automation, and you are acting as the detached scientist, observing the reaction, not participating in it. This architecture, the pre-mortem, the behavioral metrics, the physical separation, is how you build the professional mind. It is the framework of detachment. But what happens when the market delivers a shock? What happens when you follow all the rules and the market delivers 3 consecutive full-sized losses? How do you maintain this psychological fortress when the evidence seems to suggest your system is failing? That is the final test of the detached trader, and it requires a deeper understanding of probability itself. That deeper understanding of probability must be internalized, not just memorized. Because when those 3 consecutive losses hit, your brain doesn't see statistics. It sees pain. It sees failure. It sees the ego being dismantled trade by trade, and it demands that you react. The market in that moment is not testing your strategy. It is testing your identity. It is holding up the final mirror. Look closely at your trading results, and you will see the precise topography of your inner world. If your internal state is one of reactive fear, impulsive greed, and unmanaged ego, your trading results will perfectly reflect that chaos. They will be volatile, unpredictable, and ultimately unsustainable. You might be able to pull off a lucky month. You might even string together a profitable quarter. But sustained, multi-year profitability, the kind that allows you to truly scale capital, demands a psychological foundation that is absolutely still. Detachment is not a luxury for the profitable. It is the prerequisite for scaling. You cannot pour $1 million of capital onto a mind that is still reactive to a $500 drawdown. The system will break. Your chaos is expensive. We are talking about a fundamental shift in who you believe you are when you sit at the screens. Most traders start with the identity. I am a trader who makes money. This identity is fatal because it ties your self-worth directly to the daily profit and loss statement. When the market takes money, it feels like the market is taking a piece of you. This attachment is why you revenge trade. It is why you move your stop loss. It is why you feel the burning need to be right about the direction of the next candle. The successful, detached trader understands that the identity must evolve past the outcome. The identity you must forge is this: I am a risk manager who executes a reliable, tested edge. Notice the difference. A risk manager does not care about the outcome of the individual trade. A risk manager cares only about the integrity of the process. They care about position sizing, about the placement of the stop loss, and about ensuring that the next 100 trades are executed exactly according to the plan. They are committed to the long game, focusing on the statistical reality of their edge, measured by metrics like the profit factor over hundreds of executions. If the profit factor remains stable, the risk manager remains stable. This is where detachment stops being something you do, a meditation technique, a mantra, and starts being something you become. It is a state of being where the emotional feedback loop between the market and your mind has been severed. You accept the loss before you even enter the trade. You are trading the plan, not the feeling. You are executing probability, not prediction. The moment you become detached from the outcome of a single trade, you gain ultimate control over your career. When you stop fighting the market to prove you are right, the market stops fighting you. It simply becomes a neutral environment of opportunity and risk, requiring only the disciplined application of your system. But the commitment to this new identity is tested constantly. It is tested when you see the perfect setup, and the market immediately reverses, hitting your stop loss. It is tested when the trade goes 3 times your risk unit in profit, and your hand hovers over the mouse, wanting to lock in the gain early, ignoring your preset take-profit target. This impulse, this desire to intervene in the process, is the last shadow of your ego demanding control. If you want to know how detached you truly are, look at your largest loss. Not your average loss, but the single largest loss you have ever taken. That number is the exact quantifiable measure of your current level of attachment. That loss is the price you paid for control, for the belief that you knew better than your system, or for the refusal to accept that you were wrong. That loss is the monument to your ego. It is a painful truth, but it is necessary. Sustained profitability is not given. It is earned through psychological rigor. You must look at that number, that maximum drawdown, and understand that until you resolve the internal mechanism that allowed that loss to happen, you will never truly scale your account. You will always self-sabotage, because deep down, you are still operating from the identity of the reactive gambler, not the stoic risk manager. The question is, now that you have seen the mirror, now that you know the true cost of your attachment, what are you going to do about it? How do you dismantle that ego and rebuild your internal operating system for true, long-term consistency? The answer lies in mastering the final, most dangerous illusion, the illusion of control. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I am talking about Reminiscences of a Stock Operator. It is not historical. It is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.